All right, welcome everybody. Let's give everybody a minute or two to get signed in here. We're going to cover a fair amount in the next hour, but I feel confident this is going to give you your PhD in all things paying for and borrowing for college. We've been working pretty hard in the background to make sure that we have got ourselves really educated first and foremost, and really talk through the pros and cons of what all the options are going to be. And then obviously with all that's transpired in the last couple of months here, there's some new iterations this year. The biggest one being the timing itself. Usually we would have done this about a month ago, sometimes even a little bit earlier, but just like you guys have all experienced to varying degrees, timelines for most things have been pushed back, and this is no exception here. And we're still waiting on a lot of states that offer loan options for college still haven't been released yet. So so kind of with that, let's get started here. As most of you know, I'm Matt Carpenter. We got Bill Rabbit that's going to be in the background. I'm up here at our office in Salem, Mass. We got Bill back there.
Hey everyone.
Yeah, Bill's down there in our headquarters in North Jersey. And what we're going to do here is I'm going to be showing you a presentation. I might use the whiteboard a little bit, kind of taking you guys behind the scenes to our war room here as we work through each of our options and get a good understanding of each. But any questions that you have, please put them into the Q&A, okay? Because when you put them in the Q&A, everybody can see your questions. Bill's going to help you out with your answers, and if there's some particularly good questions or we're getting a lot of similar questions, Bill will interrupt me and we'll make sure that we address that live. And the other thing is you guys are all going to get the recording of this. You're going to get the slide deck itself and some other collateral with that. And you'll be able to see the questions and the answers as well. And if you want to do it anonymously, you have the ability to do that. So if you want to type a question in there, and you don't want to identify who you are, no problem. You can just do it anonymously, but that way everybody can benefit. And that's kind of the idea here. If you have a question, it's probably going to apply to more than just your family. So again, please get interactive in there. I think the more interactive it is, the better off you guys are going to be, the more that really you're going to learn. So one thing that we've always been proud to be able to say is that we don't have any formal relationships with lenders or anything like that. So any recommendations we make, we don't really have any skin in the game. We don't benefit from it. We've always been able to say that. Now, in full disclosure, we're kind of trending towards some formal relationships. I guess the one quote unquote formal relationship, which is technically not with CFS, but the software that we're a part of, we have with Credible. So one place that we will recommend you guys visit if you're targeting a private student loan is going to be Credible. We're also talking with Sally Mae, but that's kind of a full disclosure type of deal. My takeaway or my point is that our approach to this kind of remains as it always has been, is we want to get you educated on the pros and cons of all of your options. And whether you choose federal or whether you use home equity, we're just trying to help you make the best decision, not steer you in any one direction. So I think that makes us pretty powerful in that sense, and that we're not employed by any of these lenders that benefit if you go one direction or the other. So, and the other thing is, this is kind of the beginning. This is your foundation. Now, I'm confident this is going to be a really, really good foundation. So for most of you, you're going to be able to leave this and say, hey, after, knowing what I know now, the solution is for me is probably pretty apparent, but we're not going anywhere, right? So we want to continue to talk with you until you feel like your family has the best solution in place and you know exactly how you're going to pay for this, not just for this year, but for all 4 years of college. Again, we're not going anywhere. This is going to be a great foundation for you, but just kind of hold that in your back pocket, whether you're talking to Jared, whether you're talking to myself or Bill or Matt or whomever, we'll get you to the finish line as promised here. So without further ado, let's get into it. I'm going to shut my camera off and hopefully show you our presentation here. And I know I'm not showing my screen just yet, but bear with me. Okay. Bill, and just tell me, am I showing my screen here?
Yep, you're good.
Okay. So how are we going to pay for this whole thing, right? Now we're really at the now we're at the finish line, right? Now all of us know where we're going. We know exactly what it's going to cost, at least for year one. We have an idea for all 4 years. So how do we actually pay this bill? For those of us that have to borrow, what's the best way to do that? And that's what we're going to get you really educated on here in the next hour. So most colleges are still, we're seeing a little bit of a delay, but for most colleges, they're going to issue the fall semester bill around July 1st. Most of them want that due around August 1st. Now, again, just like everything, this is more fluid this year than in years past, and every school is different, right? Those are your most popular kind of dates that probably 50% of the colleges fit in that bucket. But again, everybody is different, okay? And most colleges will issue the spring semester bill around the middle of November, sometime around Thanksgiving, that are usually due in and around mid-December. Some of them have them due after the new year. Again, it's your college that you're going to hone in on to make sure you're clear on when the bills are being issued and when they're due. And with very few exceptions, you're billed twice throughout the year. So, if we owe $40,000 for a given school year, we're going to get a bill for $20,000 for the fall semester, $20,000 for the spring semester. Okay. Now, educational loans are different than standard loans. So if you've, done a refinance or taken out a home equity line or applied for a mortgage, that's a beast of a process, where it's oftentimes taking months. Most educational loans are at the quickest, instantaneous, at the longest, a few business days. So even if we had a bill due Friday, for just about any educational loan, that's going to be enough time to actually apply for the loan, get approved, and have the college get notified. Okay. So a lot of people, and I don't blame them, feel like, oh my goodness, we don't have any time to get this done. We got to come up with $20,000, by August 1st. We're really up against it, even though it feels that way. In fact, you are not. And we advise, generally speaking, and again, a little bit more fluid this year, that by the middle of July, by about a month from now, we want to have our kind of select the option, the route that we want to go if we have to borrow, and start executing that again about a month from now. Now, some colleges are going to bill a little bit earlier, so they might have due dates a little bit earlier. So again, you have to hone in on your particular college, but generally speaking, that's our rough timeline. Okay. So before we borrow, something that we like to say is, well, what's the best way to borrow? Well, the best way to borrow is to avoid it altogether, right? If we don't have to borrow, we don't want to borrow. Now, we're still going to recommend you take the federal student loans regardless, which I'll touch on in a few minutes here. But to the extent that we can, we want to reduce the amount that we have to borrow or delay it, right? With very, very few exceptions. If we don't have enough in savings or enough in our 529 account or something like this to pay for all 4 years of college, but we could pay for 1 or 2 or 1.5 years, almost always we're going to recommend to pay for that up front, because we want to delay borrowing as long as we can. Even if we can delay borrowing for a semester, we'll do that, because for every single parent loan, okay, and there's no exceptions to this, as soon as that money's dispersed, the meter starts running on the interest. Okay, so if we can delay when we have to have the meter start running on the interest, we'll do that. Okay, to the extent that we can. So we want to talk through, some of us again have some savings. We can pay for at least partially, or at least for some of these years. So when should we use what? What makes sense to use first? And this is kind of going back, kind of a review for some of you guys, but you may recall that any money in the student's name is kind of the first place that colleges look in terms of, their lowest hanging fruit for what they're going to expect to come to them. So especially if we're a family that's eligible for need-based financial aid, we want to use any money in the student's name first. So if we have a custodial account, UGMA or UTMA, if there's a savings account in the student's name and a percentage of this is earmarked for college, this is the first place that we're going to withdraw from. Okay. And then we have our traditional savings plan. So, for most of you, that means a 529, right? That's the next place that we're going to draw from, because if we don't use 529s for college, there is a penalty. We can have access to that money if we're lucky enough to have a surplus, but there is a penalty. We don't get those same tax benefits unless they're used for college. So again, we want to make sure that we use those before any other resources. And the only the only time that we would pause there is that if the 529 is owned by someone aside from the parent. So if we have a grandparent that owns the 529, there are times where if we use that money in freshman or sophomore year, that could negatively impact our financial aid eligibility for subsequent years of college. Okay, so generally speaking, when we have a grandparent that owns the 529 that's going to contribute towards a student's college cost, and we're eligible for need-based financial aid, so we're going to school, we receive some financial aid, so we want to make sure that we get that for all 4 years, we're going to see if we can hold off on using that 529 money until junior and senior year. So, of course, again, this is a case-by-case basis. So this is one where if you're a family that fits into that bucket, we'll want to make sure that we collaborate. For some of you, we have been already. But there is again, something to think about there when it's a grandparent or an aunt-owned 529 as opposed to just a parent that owns that. Okay?
Hey, Matt, let me jump in here. We have a really good question I think the group can benefit from. What's the difference between when you say college savings plans in number 2 versus a 529? Could you speak to the
Yeah, sure. So listen, for the most part, it's semantics, right? For the most part, again, have the same benefits with a few different names. So 529s took over as the biggest, dominated this whole market, whereas initially there was something called the ESA plan was very similar to the 529, but they had limits in terms of how much you can contribute towards it each year, pretty low limits per student. But the idea is that they are all investment vehicles that grow tax-free and you can withdraw from tax-free so long as they're used for higher education. And another thing to keep in mind here is you can use them for grad school, and just recently now you can use them for private high school as well. So there's been some more flexibility there. But again, so long as they come with these tax benefits, we don't really care what you call them. 529 U Fund is a plan that's specific to Massachusetts. Some states have their own variation of the 529. ESA is another example. And again, those are just a few of the more popular names and designations for the college savings plan.
Yeah, and I think the clarification, if I'm reading the question correctly, is, to clarify between, that group of, investments like Matt said, 529s, ESAs, things like that, those are considered for financial aid parent assets versus, traditional just savings accounts at the bank, or if there's UGMAs, things like that, where it's a student-owned asset. That's really what we're driving home here, is that ideally, we'd want to use student-owned assets before we go to the parent-owned assets. I think that's what we're driving at here.
That's a big takeaway. That's right.
That's the big takeaway, and that's why we would use number 2 prior to 3.
That's right. Yep. Good call. Yep. So, and then again, now, are there any other funds earmarked for college? Some folks have specific stocks, mutual funds, things like this. Now, again, we have to keep in mind, anytime we're liquidating something that's in the market and there's going to be a capital gain that could, increase our taxable income, which could negatively impact need-based financial aid for subsequent years. So for things like this, we want to make sure that we are really clear about what some of the ramifications might be of liquidating anything. But again, the point is that first it's money in the kid's name, then it's our specific college savings accounts, and then it's our next resources. Okay, so any other savings we might have or gifts that are coming from the outside. Private scholarships are starting to roll in, so this is around the time of year. Some of you have already received some private scholarships locally, or hopefully can expect to. And then we drill down to things like, hey, are the students going to be contributing anything Are there some tax credits that we haven't been eligible for previously that we're going to be now that we have a kid in college, which I'm going to spend some time on in a bit here. And then finally, loans, right? That's kind of our last resort. But again, to the extent that we can delay that or bring it down is what we want to do. Okay. And so after our savings, our investments, cash is king, right? So can we, utilize any cash flow to help reduce, again, the amount that we have to borrow? And this sounds, I guess, very obvious, kind of common knowledge, but I at least want to talk through some things, because every year we'll have some people that will benefit from some of the ideas that we've uncovered, that we share. And again, that's why we want to make sure that we get these out there and at least get you guys thinking, because college in general, right? This is one of the major financial benchmarks of your life, right? It's maybe buying your first home, sending your kids to college, and then retirement. I mean, it probably makes the top three, right? And if not, it's pretty stinking close. So we always look at this like, hey, you got this big, giant, scary expenditure, but let's use it as an opportunity, this benchmark, to really do some good self-analysis on our financial picture and say, hey, are we as efficient as we can be across the board? And if we're not, could that free up some cash flow that could be reallocated towards college? So we'll talk through that in a second here, but most colleges accept a payment plan, okay? And most of them, it's 10 months, okay? It's a 10-month payment schedule, okay? There's usually a little fee to set this up, but there's no interest, okay? So it's anywhere from maybe $50 to $100. Usually they use a third party, through their college's registrar or through their bursar's website. But the big takeaway, again, is you do not have to do a payment plan for the entire amount. So, for example, if your bill is going to be $40,000 for the year, that doesn't mean that you have to do a $4,000 monthly payment for 10 months, which might not be sustainable for your family. But maybe you figure out that, hey, you could do $500 a month. Well, that's $5,000 less than you're going to have to borrow, plus interest there. So again, now's a great time to do some self-analysis and see what we can do from a cash flow standpoint. But again, not every school offers the payment plan, and some schools, some of the bigger state schools, for example, don't offer the 10 months. I'm thinking of Michigan State is just popping into my head. They only offer a 3-month payment plan. So they're kind of a pain. But again, that's why you got to hone in on what are your school's options. So to me, a big takeaway that kind of resonates is that every $100 a month for cash flow that we put towards college is $5,000 less than you as the parent and or your son or daughter has to borrow. Okay, so if we look at college as a 4 years, right, and we say, and if we could use $100 a month out of cash flow, 48 months, just under, $5,000 less than we would have to borrow. So to me, that kind of mentality jumps off the page, where I look at that and I go, hey, if I can do some house cleaning and I free up $200 a month in cash flow that is not being wasted each month, or whatever the appropriate word is there, that would be almost $10,000 less that I would have to borrow, or my kid would have to borrow. So that's why I think it's helpful to, and again, we're going to go over some particular strategies and recommendations there, but to me, I hope that kind of resonates. Okay, so now that we have a kid in college, we may be eligible for tax credits, and even if we're not eligible, we might be able to get creative in capturing that anyhow. And we're going to talk through both features here. And this is an important one now, because it's not nothing here. It's $2,500 a year, per kid. So even if we have 2 kids in school, that's $5,000 a year. So it's really $10,000 per student. So we want to make sure that we capture all of this. Now, if your AGI is less than 160,000, you're eligible for this, and it gets phased out from 160 to 180. And if your adjusted gross income is above 180,000, that's when you're not eligible again, unless we can get creative in capturing this elsewhere. But let's first talk about the families that have an adjusted gross income of $180,000 or below. So number one, you're just going to want to ping your CPA to make sure that he or she knows, hey, we got one going off to college next year. We want to make sure that we take care of this tax credit. You're going to get you're going to get something from the college to give to your CPA to make sure this happens kind of automatically. But there is something that you need to be aware of that we find that even most CPAs are not aware of. Okay. So there's this weird little wrinkle here where in order to get the American Opportunity Tax Credit, the full $2,500, when you pay this bill, $4,000, at least $4,000 has to come from a resource that is not your 529. And I know that's confusing, so let me walk you through the scenario here. So I use this as example of, let's say that your bill for the year is $40,000, okay? And you have $50,000 saved in a 529. Well, what most families would do is they'd say, okay, our bill's 40 grand for the year. We're going to get a bill for 20 grand for each semester. We have that all in the 529, so we're going to pull it right out of there, and we're going to pay 100% of the bill from our 529 proceeds. Well, in doing that, we would have left $2,500 on the table. Okay, fairly costly mistake. So what you need to do in this scenario is when that first semester bill comes for $20,000, you pull $16,000 from your 529 and $4,000 from any other resource, checking account, saving account, payment plan with the college, any other resource aside from the 529. So it's this sneaky little thing that the IRS does that really disqualifies a lot of otherwise eligible families from getting this full $2,500 tax credit. So again, it's an important thing. We'll send out a reminder to you guys, but consider this your really formal fair warning that especially if you have that AGI below these thresholds, you don't want to pay the entire bill from the 529. $4,000 has to come from another resource. Okay. So that's really important. So there are some ways, and for some of you guys, and oftentimes business owners, we might have to talk through this in a little bit more detail offline. Often we have a CPA that kind of specializes in this, and she's actually put together a document for us and our clients and their CPAs to put in writing some ways that you can in fact capture this tax credit through other resources, which will include in the follow-up to you guys. Okay, and the easiest way to do it is that if you are a business owner, and another potential way to do this is if you have rental property or investment properties, you make your student an employee of that business. Again, if you're a business owner with a more standard business, make them an employee of that business. Okay, now the big thing is you can't claim them as an exemption on your tax returns. Which is not a big deal, because if your AGI is over 180,000 anyways, you're really not losing anything there. But so long as they show some income from the business, and our CPA usually recommends between 10 and 15,000, and they claim themselves as an independent that's also going to college, they can claim this $2,500 tax credit. So it's a really nice workaround for families that, again, can kind of check these boxes. And again, for business owners, there are some tuition repayment plans that again get a little bit more complex and only apply to a small percentage of you. So I'm not going to do the deep dive here, but again, something we should talk further about because you can be eligible. There's some nice tax opportunities here once you send your kid to college if you are a business owner. So,
hey, Matt, a couple of good questions here with regard to the AOTC. Is taking the federal direct student loan, the $5,500, count towards the $4,000?
It does. It does. Yep. Great question.
Okay. Let's see here. So the AOTC can come to a parent or also the student. I think you just
generally speaking, it comes to the parent. The student can only get it if they claim themselves as independents and show and show their own income, and also prove that they're going to college as well. And there's not a definitive number for how much income that they have to show, but the point is, with the IRS, is that they show enough that they can reasonably state that they're independent. So again, our CPA generally recommends them showing a minimum of $10,000 for income there.
Yeah, and then that actually was another question that kind of came in. The earned income source for the student, can it come, I'm sorry, the earned income for the student, can it come from any source? So the answer to that is yes. If you're trying to claim the tax credit through the child, there has to be a sort of, um,
You got to make a reasonable argument that they are in fact financially independent. So $10,000 would be probably pushing your luck a little bit. And again, we're not CPAs, and those are not firm recommendations. There is a little bit of wishy-washiness around that rule, specifically that one, because there's not a minimum threshold that the IRS has. But again, you're probably asking for somebody to take a closer look if that number is too low.
Yeah. And then, when we talk about the college bill, are we talking about tuition or all costs together as far as the
we're
$1,000?
talking about all in. Yeah, we're talking about all in here. So when I say $40,000 per year, tuition, room and board, fees, even if you live off campus, that's still kind of included in that kind of big nut here.
Okay. So we have a couple of good questions with regard to 529s and grandparents. Do we want to hit on that now before we get moving forward, or do you want to save those towards the end?
Let's save that towards the end. Yeah, let's save that towards the end. Please make a note, make sure that we do get to it. But for some of these that are only going to apply to a smaller percentage of folks, we'll save that to the end. So if people want to drop off, they can. But I will assure you that we will hit that.
Okay.
Okay. So again, we talked about this, chance to free up some cash flow. Look at this not as this huge challenge, which it is, but an opportunity to make sure we're doing everything right elsewhere, right? And clean out our kind of virtual junk drawer. Okay. So, are you making sure that are we paying as low of taxes as we possibly can? Are you paying as low of insurance as you possibly can? And just kind of an FYI here, we have some friends in the insurance industry, and some of you may experience some of this, but a lot of insurance companies, what has happened right now during this pandemic is that their margins have gone absolutely through the roof, specifically auto, because nobody's been driving. So they're not paying any claims, and they have more money than they know what to do with. For example, my auto insurance company, we just got a notice to say we've reduced your claims by 20%, or we reduced your monthly payment by 20%. We didn't ask for it. We didn't put in any sort of thing. And I happen to know the owner of that insurance company. And I was just texting with them on the side to say, thanks, buddy. Is this just for me, or what's this? And he said, no, like literally we have more money than we know what to do with. So we almost feel bad. And we're kind of getting ahead of any potential backlash. Here's the takeaway for you. If you haven't done this already, call your auto insurance, call any other of these types of insurance, ask them for a discount, say that that their competitors are doing it, you're very likely to get one. And again, if they reduce that by $50, well, we'll reallocate that towards college. Okay. So again, I know we're not moving mountains here, but this is a great time to just kind of get smart, right? So what do you pay for your phone? Could you be doing better? Right now, so many people are cutting their cable bill, and I always do this for every year and a half anyways, just call to say that I'm leaving, and every single time the conversation ends with, getting my bill down $40 a month or whatever it happens to be. But if you say you're cutting the cord from cable, they're going to kick you over to sales before they actually let you to go to see if they can play Let's Make a Deal. So again, can you reduce what you're paying there, what you're paying for these kind of smaller ticket items? And then, this is a great time to figure out how much does it cost on a monthly basis for our son or our daughter that's going off to college to live at home, right? So even for our families that say, hey, we have zero extra monthly cash flow, which is a lot of you, right? We're just happy when we can make our mortgage, pay our credit cards, pay our car bill, and that's it, right? But we always kind of push back on that a little and say, I bet it's not free for your son or daughter to live at home. What do you pay to feed them each month? Are you paying for clubs, for, sports, things like this? Let's figure out what that dollar amount is and reallocate it towards college. You're not changing your monthly cash flow at all. You're not reaching further in your pocket. You're just reallocating. So again, now's a great time to go through that exercise. Okay. So we've kind of talked through, if we have savings, when do we use what? Okay. can we make sure that we're maximizing the tax credits that we could potentially be eligible for? And again, maybe we can put those towards college costs, right? You're getting a $2,500 that you weren't getting previously. So don't put it in your pocket, just put it towards the next bill. Okay. But no matter what, just a large percentage of you are going to have to borrow something. And speaking on a high level, it would make everybody's lives easier, yours and ours, if we could just say, this is the best way to borrow. This is the best loan. But as we go through this exercise, I think it'll become apparent to you that, it's very common for us to maybe have 3 meetings in a row with a family, and we're making 3 different recommendations for how they should borrow based on their particular scenario. Okay. So there is no one size fits all. And ultimately, it's going to come down to your criteria. What kind of bucket does your family fit in? What's most important to you? What do you want to avoid? What do you want to make sure that you take advantage of? And we're going to help you figure out what your family's criteria is, right? For probably all of you listening right now, if I said, what kind of borrowing criteria you're looking for, you'd probably say, well, I have no idea, right? So we're going to help you sort through that as we talk through this here. Now, you're going to see a lot of verbiage on some of these screens. I'm not going to read through all of it because you're going to get, you're going to get all this information here. But one thing that I can say that is universal, that is one size fits all, is that we're recommending to each of you, just like we do every year, that every single student take advantage of the federal government student loan that they're entitled to. Now, for all of you, we've completed the FAFSA. So by definition, every single one of your kids is entitled to that. And they can borrow up to $5,500 their freshman year. It'll go up to $6,500 sophomore year, and then it'll cap off at $7,500 for junior and senior years. So for a total of $27,000. And I want to talk about a few things here. Number one, if your kids graduate with $27,000 in debt from the federal government, from the federal government via this direct loan, you've hit a grand slam as a family. Okay, I don't care what they majored in. I don't care where they go to college. If they have $27,000 in federal government student debt, you've hit a grand slam as a family. Many, many, many families are going to have the students borrow more than that. So who I'm talking to is really families that are hesitant. Is this too much to borrow? The answer is no. I can say that with confidence. Okay, the answer is no. Now, again, some of you still are in that fortunate position where you don't need your kids to borrow. Maybe you don't want your kids to borrow, but we're still recommending that they take advantage of this. And here's why. And there's a couple of reasons. Number one, if you want, you can take out this loan in their name. It's only in their name. There's no co-signer. They don't have to have any established credit. Okay, and you can pay it off the next day. And that way you will establish credit for them. So again, even our clients that are in that fortunate position to have the resources, we still have them do that. So then the kids graduate as 22-year-olds with established credit. So it's a very, very nice perk. The other thing here is that if things change in subsequent years, it's going to behoove you that you've taken advantage of this student loan every year for a few reasons. Number one, you can't go back in time and take it again. So you can't say, hey, we lost our job in sophomore year. We'd like to have our kid borrow the $5,500 and $6,500. It's use it or lose it. It doesn't work that way. Okay, you can't go back in time. And the other thing is, if you do have an unfortunate situation that has changed, you're going to be much more likely to have a school work with you from a negotiating appeal standpoint if you've demonstrated that you've taken out the federal government student loan that you've been offered. And we have lots of tangible evidence, lots of individual families that were in a great financial position one year. That changed, but by doing this, we got the school to work with us. For the families that chose not to do it, in many cases they did not, because they say, hey, we tried to throw you a bone initially and you didn't take advantage of all the quote unquote financial aid that we offered. So we're not willing to help you now. We're willing to help you less. So it's a firm recommendation. Everyone take advantage. Of course, it's your choice, but we go on record saying that it's a firm recommendation. Okay. And you will see that some of these are subsidized, or an amount is subsidized versus identified as unsubsidized. The difference being the subsidized portion does not accrue interest during the college years, whereas the unsubsidized portion does. The meter starts running right away. Now, again, we're talking about a very low fixed rate. This is the lowest rate in history of this loan program, 2.75%. Okay, so again, we're borderline talking about free money here, guys. So this is where we want to start. I will send you, in addition to this presentation, we're going to send you kind of a cheat sheet. So in order to actually execute this federal direct loan, the students, okay, need to complete two steps online at studentloans.gov. So the 2 steps they need to complete is what's called loan counseling, and then they complete a loan agreement, okay? Generally speaking, this takes between half hour to maybe an hour or something like that. So it's a fairly big ask for 16, 17, 18-year-olds. We kind of have a cheat sheet way of doing it, which I'll send you that video. I just literally film myself to say, here's how to kind of circumvent these quizzes, for lack of a better word, that you have to take. And if you follow that step by step, it'll take you about 5 minutes. Now, this is not how the federal government would like you to do it, nor is it maybe you as the parent, how you would like your son or daughter to do it, because the point of this is they're saying, hey, listen, to get this money, we're not asking you to have established credit. We're not asking for a co-signer, but we want you to understand what you're signing up for. You're borrowing $5,500. Some of this might accrue interest. Here's what interest means. And ultimately, do you promise to pay us back after you graduate? You're going to get your first bill 6 months after graduation. So you may want your kids to actually go through the monotony of that process for some education and things like this. So for those of you that do disregard this kind of cheat sheet video I'm going to send you, for those of you that just want to bang it out, now I know, if we're being honest here, probably 75% of parents complete this step for their kids. So for those of you that fit into that bucket, you're going to want the little cheat video that we're going to send there. Okay. Okay. Now, how much?
Matt, a couple of questions quickly that came in with regard to the federal direct student loan I want to address. So, after July 1st, 2020, will the fixed interest rate increase or decrease?
Yeah.
But
sorry, go ahead.
No. Good.
Oh, okay. So the deal is that this is it's a little bit confusing how the federal government does it. That's when it formally changes over, okay, to the 2.75%. But for everybody that's borrowing next year, whether you complete these steps before July 1st or after July 1st, you get that 2.75% rate, okay? So it doesn't matter if you complete it now or after or on July 1st. It's confusing, so that's why it's a good question. But everybody that's going to college next year is going to get that rate. The federal government doesn't formally change it until July 1st, so it's just kind of a weird nuance.
Yep, and then as far as, the $5,500, the federal student loan or the FDSL, it accrues interest right from the go. And when we're not using it, should we wait until the end of the year to take it out? So the timing of the loan and
you don't get it. Yeah, that's a good question. Just how educational loans work in general. You don't get a choice, right? So what happens is you complete these 2 steps online. You complete the loan counseling. You complete the loan agreement. You get the $5,500, and the Department of Education, the federal government, disperses that directly to the college, half of the fall semester bill, half of the spring semester bill. And that's how all the loans work. So if you take out a private loan through Sallie Mae and you ask for $30,000, they're going to say you're approved, and Sallie Mae will send $15,000 to the college for the fall semester, $15,000 for the spring semester. So across the board, that's kind of how the logistics of these student loans work. They don't cut you a check that you then cut to the federal government, or I'm sorry, to the college.
Yep. And what was last year's rate, Matt? We have a question quickly.
I'm going off the top of my head here. Is about 4.3 though, and I think I nailed that. Okay. Okay. So how much is too much for students to borrow here? And this is not an exact science, but at the same time, this is rooted in math and economics. Okay. And a great way to get a back of the napkin ballpark for what is at least something that we can feel pretty comfortable about being able to reasonably pay back is that we don't want to borrow more than the average starting salary by major. So again, you guys can understand how this is not perfect here, but we have some general guidelines for average starting salaries, again, by major here, that we would like to stay within. And what it means is that, hey, if I'm an engineering major, on average, and again, we get a great variation based on a school, based on the region of the country, et cetera. But national average, I can expect to start at about $63,000. And what that tells me is, me as the student, I don't want to borrow more than $63,000 ideally for this undergraduate degree. And I'll tell you why, because how we've kind of reverse engineered this is that we've said, okay, if I'm going to make $63,000 for an annual salary, here's on average what my take-home pay is going to be, versus if I borrow $60,000 for college, here's on average what my first monthly payment is going to be. And is there enough of a delta there, a difference, that I can maintain a reasonable lifestyle? Can I be independent? Can I pay rent? Can I drive a car? Can I pay for my own cell phone? Or am I going to borrow so much that my first monthly payment versus my take-home pay is going to put me in this situation where I'm like, man, I have to live at home with mom and dad because there's no way I can pay this rent, right? So that's a basic metric that again is rooted in some actual math that can help families get a general guideline of like, okay, how much is too much for my kid to take on here before they're really not going to be in a great position. Now, some families just don't have the liberties here of being able to be strategic here, and they just got to figure out, hey, they're going to have to borrow X amount, and we just got to figure out the best way to do it. But I think and I hope that this is a decent kind of foundation to get an idea of what's a reasonable amount here. Okay, so now let's talk about, we're going to start at the federal government student loan, and now we're going to talk about, okay, if we're a family that needs to borrow more than that, what is the best way to do it? And there's three basic buckets that we can put any educational loans in. And then we're going to talk about a fourth bucket, which are alternative options. Okay, but there's three basic buckets here. And after the federal direct program for students. Okay, so if I'm a parent and or a student that needs to borrow above that $5,500 next year or years beyond, what are my options? What are the pros and cons of each? Which one or ones make the most sense for our family? So that's what we're going to talk through here. So we have the federal program, in some cases, the state program, and then the private sector. Okay, so we're going to hit on each one of these right now. Okay, so the PLUS loan is the name of the federal government program for parents that are borrowing for college. Okay, that's the name of this particular loan. One of the things that we have to address right out of the gates is that only the parent or parent's name appear on this loan. The student is not on this thing in any capacity. So if we're a family that wants to make sure the student has a formal obligation to the loan here, we may cross the PLUS loan off. We might take that off the table as an option right out of the gates. Okay. Now, we still have some families that will use the PLUS loan, and they will have their son or daughter pay it back once it goes, once they start making payments after graduation. But that's going to be, by attaching their bank account to it. But that's going to be a handshake agreement between the parent and the student. Okay, they will not be formally attached to the loan. If the student kind of ditches on it, it's only mom and dad's name that's going to appear on that. So that's something that, again, for some families that doesn't matter. For some families it does, but it's our job to make sure that you understand that. Okay, and this is something that the application process itself is very, very easy and very quick. You find out quite literally instantaneously whether you've been approved or denied for this. Okay, so again, it can only be issued in the parent's name. There's an origination fee here that's pretty big. So you're going to see that some of the other sectors have a smaller origination fee, or they don't have one at all. And of course, like all these, a lot of this stuff is buried in the fine print, but there's a pretty high origination fee that comes off of this loan right out of the gates. Now, this is, again, just like the student program, this is the lowest fixed rate in the history of this program at 5.3% right now. Okay, so it's 5.3%, and again, it's not going to change. It's after July 1st here, but that's when it becomes kind of formal. And really, this rate used to be a little bit prohibitive, which is why it probably lives in the cons category. But probably not fair to put that there now, as it is a pretty competitive rate, specifically in this market. Okay, so let's talk about some of the better features of this program. Number one, that we can defer payments at no additional cost. So in other words, we don't have to make a payment on this until 6 months after our son or daughter graduates from college. Okay, and it doesn't change the rate of the loan if we decide to do that. We have to be aware that the interest is going to be accruing in the meantime. Okay, and there's also no prepayment penalties. So this feature can be really nice, for example, for families that have a fluctuating income. Maybe folks in sales or that own their own business. They don't have this kind of consistent monthly income. You have the ability to say, hey, I don't want to have to make a payment for 4.5 years, but I know that bill's coming, so I want to chip away at it as feasible in the meantime, and that gives you the ability to do that. So I don't have to make a payment for 4 years and change, but if I have a good quarter, I get a big commission, boom, I can throw a lump sum at it any time that I want to start to, at the very least, keep interest from accruing too much, but hopefully start to eat into that principal as well. Okay. The federal government is, in my opinion, the most flexible lender to work with. We can change our repayment plan really at any time, an unlimited number of times. So if we have, if our situation changes and maybe doesn't change in the positive direction, we have the ability to adjust on the fly. And they have the most kind of options, again, when compared to other loan options, they tend to have the most. So I can put this thing on a 30-year repayment schedule. I can do an income-based plan that the amount of my payment is only tied to the amount of income that I take home. It also allows you the ability to consolidate between multiple years and multiple children. Okay, most other lenders don't allow you. A chunk of them allow you to consolidate multiple years, but most do not allow you to consolidate between multiple children. Okay. Now, as of today, there are forgiveness programs that are pretty robust, and specifically, this is for parents that fall somewhere in the civil service umbrella, and it's pretty broad in a good way. So certainly, if we're a police officer, if we're a nurse, if we're a teacher, we're going to be eligible for these forgiveness programs. And oftentimes, you don't have to necessarily be a teacher, but you could just work at a school and still be considered eligible here. So, for example, my wife works at MIT. She's not a professor. She's in administration, but technically, she would still qualify for the federal forgiveness program. Now, in years past, I would feel more confident in making firm recommendations that if you fall into one of these categories, you should seriously consider the federal forgiveness program. My only hesitation, and I'm not telling you to not go down this route, but my hesitation is that President Trump's most recent changes that he proposed, a bill that he proposed, for when it comes to higher education, a part of that got rid of the federal forgiveness program.
Hey, Matt, could you just quickly define what forgiveness program means?
Yeah, sure. So, and this is something that you're going to make, if you go down this route, you're going to get further educate yourself, and we're going to send you some literature that defines this further. But the long and the short is that if I'm a police officer, I say, you know what, I'm going to go this route. Okay, and I'm going to borrow $20,000 a year via the PLUS loan. And what we do is we put it on a deferred plan, and so now it's 6 months after graduation, and we consolidate the $80,000 that we borrowed plus interest, right? So the $20,000 for all 4 years, and then I go through the necessary paperwork to prove that I am in fact a police officer, and I get into the forgiveness loan program. And what you can do at that point, and there's a few different options, at least the way it exists today, is that, for example, you could do a 30-year repayment plan. And so long as you make your payments, anything after 10 years, okay, so long as you make your payment for 10 years, anything remaining is forgiven. Or you could do an income-based repayment plan. And again, so you might have a lower income, so you have an easier monthly payment. And then after 10 years, so long as you made payments for 10 years, anything after that is forgiven. Okay. And there will be a tax hit that year. So for example, if you have $30,000 forgiven, 14 years from now, that $30,000 will be considered taxable income. Now, when we net it all out, you're very likely still winning there. But that's kind of how it works. So again, the reason why I have more pause this year than I did, for example, last year, is that was the bill that was proposed. We don't know if it's going to go through or it's not. But either way, in order to get into this forgiveness program, we got to check a big couple of boxes. Number one, we don't apply for it until 6 months after graduation when the loan comes into repayment. Okay, so that means that's 4.5 years from now, and we don't know exactly what this is going to look like at this point. And we have to be employed through this civil service program for all 10 years. So it's one of these things where we do have to look out long term and say, well, I have to be, in this same role about 14 years from now in order to capture this. All the advantages. Okay. Now, the other thing to consider here is we've had plenty of families say, hey, well, who knows how it's going to play out? And I don't know if I'm going to still be employed there. But it's not like they're in this terrible situation by just being in kind of the standard plus loan deal. The families that really have to think close is that we've had a few families that have chosen to take a gamble and on this forgiveness program by borrowing way more than they needed to. With the hopes that someday a big chunk of it is going to get forgiven. That's when you got to take a closer look. Okay. The plus loan is probably also, one that you want to really, really consider if you know that you're a parent that does not have good credit, or has credit on the lower side or does not have a higher income. By far, the federal government is the easiest program to qualify for in that sense. Okay, and we'll talk about some of the disadvantages of the private sector, to a lesser extent, the state, if you are a family with lower credit. Okay, and I know I'm going fairly fast here, guys. We're going to go over our time. We're going to go over an hour, but I think this stuff is too important to shortchange any of it. So I'm perfectly fine with that. And again, I hope you either stay on with us. At the very least, you'll have the recording to refer back to, but I don't want to shortchange any of this stuff because it's too important. Okay. So the next big sector, the next big bucket here is the state. Now, the first thing is not every state has a program, and we can only utilize, and I'll talk about the exception in a second here, but we can only utilize the state program if the state that we live in has one, or the state our son and daughter is going to college has one. And then the one other exception here is anybody can use Rhode Island's state program. They actually have a great one. So again, to utilize a state program, it has to be one in our home state. So I'm up here in Massachusetts. We do have a program, so I can use MIFA. If my kid goes out of state, so for example, if my kid went up to the University of Vermont, well, I could also look into their program. VSAC is the name of their program. Or again, my third option would be Rhode Island. Rhode Island is a state that anybody can borrow from regardless of where they go to college and regardless of their state's home residence. So for example, if I live in New York and I'm going to school in New York, well, my only option would be would be to use Rhode Island's program because the state of New York does not have one. Okay. One of the big differences between the state programs, and there's variations between each, but there's a lot of overlap, is that now we're in a scenario where the student is formally attached to this loan, and in most cases for the life of the loan. So for families that needed to rule out the federal program because the student wasn't formally attached, well, now the state's in play in that sense. And there's also some states that have cosigner release programs. And what that basically means is that, for families that say, hey, I'm going to help my kid borrow, so I'm going to cosign on this loan, but I want to be removed from the obligation as soon as possible. Some state programs, and this is more common in the private sector, but some state programs and some schools in the private sector give you the ability to have a cosigner release. So once we're in the repayment phase after graduation, you can apply sometimes as early as a year after it's been in repayment to hopefully just have the student be on that loan, and now mom and or dad gets released from that. Okay. And again, most states don't have their rates out for next year yet. Some do. We get a pulse on this, so obviously we will remain in touch as states release their programs, which we really expect to be in the next couple of weeks and maybe as early as next week. Okay. So some of the state kind of, let me say this in general, though. Let me say this in general. Generally speaking, I think I'll get to it in a minute here, but generally speaking, the state rates tend to be lower than the federal government. I think they're scrambling a little bit right now because the federal government's never gone this low before, or really even close to it. So I think that's why we're seeing some delays from these states right now. One thing is they don't offer the same flexibility as the federal government. For the most part, what you sign up for, that's the deal come hell or high water. If you signed up for the immediate repayment, well, then we expect immediate repayment. If you signed up for the 10-year instead of the 50-year repayment, well, that's what you signed up for. So we just, again, have to be comfortable that for everything we gain with whatever option we use, there's going to be something that we give up. So we might get a lower rate through the state's plan, but we have to be comfortable with the fact that we give up a little bit of flexibility, for example. Okay, so just about all state programs allow you the ability to defer payment, meaning you don't have to make a payment until 6 months after graduation. But usually the catch there is it comes at a higher rate. So that's where it's different than the PLUS loan. And it still might be a rate that's lower than the PLUS loan. But for example, we could get a rate that's as low as 3.99%. If we start making immediate repayment on the interest and principal, but that could go up. So for example, the lowest range we're seeing in states so far this year is 3.99 if we start making immediate repayments, going all the way up to 6.5 if we want that option to defer payment until 6 months after graduation. Okay. So that's something that again, we need to just be clear on if we're deferring or not, and how that can impact the rate and repayment terms. And again, the states, generally speaking, have a harder credit requirement than a PLUS loan. So again, if we're a family that we know has lower credit, we might have a harder time qualifying for any of the state programs. So as I just kind of alluded to, oftentimes we can get a lower rate than the federal government through the state. However, it usually means the caveat is we might have to start making payments sooner, at least on the interest, obligated payments sooner. Again, we may give up some of that flexibility that we have with the federal program, but we have the student formally attached to that, so it's to the loan. So again, for families in which that's important, we're able to check that box. Okay. And again, we have variations, of course, between states. So the private sector, I mean, this is what most of us think as kind of the, your traditional student loan. So your Sally Mae's of the world and things like this. And for you parents that went to college, I guess a generation ago, you might have taken some of these loans and you didn't need a cosigner. Well, now all loans, all educational loans beyond the federal government's $5,500, each year require a cosigner. And the private sector has some kind of big variations in terms of its pros and cons. Okay. Number one, we have a whole bunch of lenders, and some people think even too much lenders, because should I be using Sally Mae or SoFi or Citizens or whatever it happens to be? And every lender has different requirements, and they're going to give a different rate and repayment term to every single applicant based on the risk or lack thereof that they think that applicant has. So let's kind of talk through some of these. Now, number one, similar to the state, and maybe even more so, we don't have that same flexibility as the federal government, as the PLUS loan. Oftentimes the fixed rate are higher than the variable. So we get a lot more variable rates in the private sector. I think some of these lenders don't do the best job of making it loud and clear that this is a variable starting rate, because they put it in, bright letters that, wow, this looks like a very, very attractive rate, but let's make sure that it's fixed as opposed to variable. And if it's variable, let's make sure that we understand what it's capped at. So that's a big one there that we want to make sure of out of the gates. And once I've applied for this loan and got the results back, is it fixed? Is it variable? And usually they're going to show us each. Okay. Now, one thing that's a pain about the private sector here that is an advantage of both the federal PLUS loan and the state programs is that with the state and the federal program, we know exactly what the rates and repayment terms are before we apply. So we can show you right now, if I do the Federal Plus program, I'm going to be at 5.3% fixed interest, and here's my origination fee, right? Right out of the gates, we know that. Whereas the private student loans, we have to actually go through the application, and then they come back and they're going to tell us, hey, here's your rate, here's your repayment terms, here's your potential origination fee, fixed versus variable, etc. And the range is very dramatic in terms of what we're going to be eligible for. Okay, and again, where we fall in the spectrum is entirely based on the strength of the application or lack thereof of the cosigner. Okay. But there are some pros, and there are some families that should use the private sector. And usually the first one will say is, if you know you're going to have a robust application, so you have a really good credit score, well, you have a chance to get a very competitive rate. And or you're a family that you really want the onus of this loan to be on the student, so that you consider this their responsibility, and you think that you would like to, as a parent, be removed from it as soon as possible. You're going to have some options in the private sector to check those boxes. And again, usually for everything we get, we are giving something up. So if we want to have the earliest cosigner release option, we might pay a little bit of a higher rate. And that's just kind of the, for any option we might land on, that's kind of the deal. And there's a fair amount of programs here in the private sector that do not have any origination fees as compared to, the higher origination fees for the federal government. Okay. Now I'm going to do a review of these, kind of all three, to help you guys start thinking about, well, what makes the most sense for my family. And I'm sure you got a lot of things swimming around in your head. So I'm going to try to consolidate all three of those in a minute here. But before I do, and again, I'm not going to go through all the ton of verbiage to throw at you guys here. But this alternative sector is, okay, we've looked at the three major buckets of the kind of our traditional educational loan options. Now, how about outside of that, what can we do? And I'd say the most popular one is any homeowners that have equity in their primary residence, right? Oftentimes this can be a really good option, and especially right now, we can get rates that are pretty stinking low, and maybe lower or as low than the lowest rate in the private sector. And there's two ways we can get home equity, right? We can do a refinance where we pull out a one-time lump sum of, hey, we want to pull out $150K. Or we can do an equity line of credit, which is we want to have the ability to draw on $150,000, but we're only going to pull out and pay it back kind of as we go. So it's usually the HELOC that makes the most sense, because number one, we're paying back and borrowing only as we go. Usually we get a lower rate, albeit variable. Okay, but right now they're very, very competitive, and we can kind of keep our eyes on it. Versus a refinance where we pull out a lump sum of, again, I'm just using that $150,000 now, because the other thing we need to think about is, well, where are we going to put that $150,000? Especially if we're eligible for need-based financial aid, we probably don't want that on the books as we're completing the FAFSA and the CSS profile, believe it or not, in just a few months here. So again, if we're going to use home equity, for a lot of people, I think that's a great solution. For most people, it's going to be via the equity line of credit versus the pulling out a lump sum that I think makes the most sense. And of course, that's not a firm recommendation for everybody, but in most cases, that's what we find. And then, of course, you got to be aware, which I know you are, that this is only in your name as the parents, and you're not going to have you're not going to have much flexibility at all in terms of your repayment terms. That's the deal. And so versus any of these educational loans, you might have some flexibility there. Now, in general, we do not want to in general, we do not want to withdraw any money from our retirement accounts unless it's a Roth IRA, which I'll hit on in a minute. So for a few reasons, if you pull money out of a 401k or an IRA, especially if you're below 59.5, which is the vast majority of you, you're going to pay a tax penalty. It's going to increase your taxable income, so you're going to get less financial aid in subsequent years. And of course, you're lowering your retirement, which we do not want to do. So with very few exceptions, we firmly recommend against withdrawing money from retirement accounts. Okay. Now, There are some firms that offer a very, very low interest rate, sometimes as low as about 1% if you borrow against your 401k. This is something that we would certainly at least consider and have a discussion around, and it's probably worth asking your employer what the rate is. But again, even if you're pulling money out of there, that money's not going to work for you in the market. You are reducing, your retirement. So to the extent that we can, in most cases, we want to avoid this, but if we can do it at 1%, it's something that we at least got to entertain. Okay. Now, Roth IRAs are completely different in the sense that, yes, it's a retirement account. So if we can, if we feel like our retirement isn't funded the way that it should be completely, maybe we avoid touching it. But if we think we're in okay shape there, the Roth IRAs really act the same way that 529s do. So we can withdraw this money and use it for college with no negative tax ramifications. So again, it is something that we want to look very closely at if we have any Roths. We find that many times families don't know this. They have some Roth money laying around, and they don't know that they can use it for college without any negative tax ramifications at all. So something to be aware of, but it's critical. It's a Roth IRA, not just a simple IRA or a SEP IRA or your traditional IRA. Okay. Life insurance. So some folks have cash value life insurance. If we use cash value life insurance and pull that money out and pay it towards college, there's not going to be any negative tax consequences, but it can and most likely will hurt our eligibility for need-based financial aid in subsequent years. So if we are a financial aid candidate and we have cash value life insurance, again, we're probably going to want to hold out until junior and senior year before we pull that money out and make a contribution if we're eligible for need-based financial aid. Okay. So we might look at as an alternative, in years 1 and 2, for example, if you're a family that has a cash value life insurance plan, oftentimes you have the ability to borrow against it. So when you do that, you can do it. And again, at usually a very low rate. And it will not show as a distribution, therefore will not hurt our financial aid eligibility in subsequent years. So those are some of the big ones to think through for those of you where this applies outside of your kind of traditional educational options. So what is the best solution, right? We just flew through a lot of information, kind of hopefully got the lay of the land and pros and cons for each option. Which one makes the most sense for your family? So this is where, we want to start thinking through some things that, and I think my video is probably up here too, but I might want to kind of point to some things as I'm going here. So, these are the questions that are going to help point you in the right direction. How much does the rate of the loan matter? So for people that walk into our office and say, hey, I don't care how I have to borrow, where I have to borrow, I just want the lowest rate. So oftentimes then my question would be, well, how's your credit? Because if you have really, really strong credit, strong application, that's probably going to be through the private sector. Okay. Or do you have home equity? Are you willing and able to access that home equity? You might want to look at home equity. Right? If we only care about the rate, that's probably going to point you in that direction. Do you care about whether your son or daughter, or as you as parents, are on the loan? How much does that matter? Right? If you need your kids to be formally attached to this loan, that's your belief system, then we can't consider the federal program. Right? We have to choose between a state option and a private option where our son or daughter is formally attached to that loan. Right? What's your credit score like? If your credit score is not very good at all, well, these private loans go from 2.75%, about 2.75% up to 15%. Okay, so if you don't have strong credit or you're not going to have a very robust application, you're probably going to rule out the private sector, and you might point towards the federal and or at least attempt to apply for the state. Okay. Now, this is a really interesting tidbit here that I want to make sure that I hammer home. If you have one parent that has a low income, or if you're a divorced or separated family in one household that has a very low income, the PLUS loan, the federal government program, I alluded to this, has a repayment plan that is just based on the income of the parent. Okay, so there is a scenario in which you can, and to give you an extreme example, and we've seen this more than Well, we haven't seen it be realized yet, but we have it set up this way. But to give you an extreme example, you might have a household that has a really low income. Let's just make it easy and say that $20,000. And at graduation, they set up the PLUS loan to have an income-based repayment plan. And if you have a $20,000 household income, your minimum payment on the PLUS loan is going to be $0 or close to it. And if you make that payment of $0 or close to it for 30 years, the loan's forgiven after that. So again, sometimes we can be strategic here in who takes out the PLUS loan, especially if they have there's a parent with low income, because we can set up an income-based repayment plan that has incredibly low minimum required payment per month. And then again, after 30 years, it's a heck of a long time, but anything left there is forgiven. Okay. And then we talked about the forgiveness programs that only exist in the federal government. So again, if we're in that civil service bucket, we want to make sure that we look at that. And then how much do we value things like flexibility, right? Insurance, where again, another word we use for that is insurance, of like, hey, my job's really contentious right now, and I don't know what's going to happen, and I just started a new business and we don't know exactly how it's going to go. That's where we're usually like, okay, well, you might want to consider the PLUS loan, because they're not like some of these guys that's more of a hell or high water, what we sign up for. And if we pull from home equity, if we're in the private sector, we're not going to get that same flexibility as the federal government that's going to work with us and allow us to change our repayments, multiple times, things like this. So again, if we value flexibility, we're going to point more towards the federal government program. Okay. And again, home equity, again, some people are philosophically opposed to accessing home equity to pay for college. That's the end of the conversation as far as we're concerned. But from where we sit, this is our philosophy. That's real money that's sitting in your walls that you've saved. That's a savings account that you can access. You just got to pay some interest to do that. But again, if we're most concerned with the getting the lowest rate possible, let's give that a fair shake. Okay. And again, as always, guys, we're not going anywhere. We're not sending you off to go make these decisions on an island. So for anybody that needs to get walked to the finish line, more of the one-on-one capacity, we're going to get you to the finish line. Again, I think this is the best place to start. I hope you learned a lot here, and you're learning, again, if you retain this and as you go back to revisit it, I can promise you have your PhD in all things how to borrow for college, because this is something that we take really, really seriously, spend a lot of time in, and try to help you guys make really educated decisions, because it stinks to borrow $40,000 for college. There's no easy way to do that, but it's our kind of genuine hope and belief, hopefully, that at the very least you're going to be able to say, okay, listen, at least I understood all my options. I understood the pros and cons of each, and this is going to be the move that makes the most sense for our family. There's a lot to be said for that, right? There's a lot to be said for that. And I know we're talking within kind of this least of evils category, but at least, again, we're not just throwing darts here. We're helping you make really educated decisions. So kind of action items moving forward, do that homework, do the analysis. I know some of the stuff is silly, calling the cable company, calling your insurance company. I'll be shocked if most of you listening can't free up another $100 by doing your homework on those things. Because again, remember, every $100 is $5,000 less that we have to borrow. Most of the schools are going to be issuing the bills around July 1st. We're recommending that we know how we're going to borrow by around the middle of July, around a month from now. And again, we'll help you get to the finish line there. And most schools are going to want the fall semester money around August 1st. But as we all know, we're more fluid than usual this year. We're going to send you a bunch of follow-ups, a bunch of calculators, in addition to the presentation itself. Some of the state programs in particular, so you can kind of fool around with some different numbers, and you will have some homework to do on your own. For the private sector, you have to apply for these loans, on your own. So we'll have a lot of supporting material outside of this presentation itself, but I hope this gave you guys a great foundation. Bill, is it for those that kind of stuck with us to the end here, which is a pretty good amount given how long we went? Are there some questions that we want to hit on now?
Yeah, I left a few in the Q&A if you want to go ahead and take a look. There's only 4 in there. I left them there because I think, it might be beneficial for everyone. But overall, the engagement was fantastic. Great questions. So if you want to go ahead and take a look at the Q&A and just, you know,
Yes, sure. So we want to, we want to hold on to the grandparent 529 in until junior or senior year to the extent that we can, so it doesn't negatively impact our financial aid eligibility. Okay. Now there are cases where you say, hey, well, we're going to need that money freshman and sophomore year. Otherwise, we'd have to borrow. Now we want to take a closer look and talk about the pros and cons of each of these. But, generally speaking, to the extent we can, hold on to the grandparent 529 distributions until junior or senior year. If the student comes into an inheritance, how should the money be saved? Again, that's one we'd have to work with on an individual basis to get the specifics. Is it going to be, is it going to be in a trust? Is it just going to be a check that goes into their account? Is it going to be invested into the market? We need specifics. So let's talk offline on that. We need specifics on how that's structured and the timing in order to make firm recommendations for, hey, how do we get this money, but hopefully have it not impact financial aid or not impact financial aid as much as possible moving forward. Okay. All right. If we refinance, so we do a large cash out for tuition, do you pay off the loans you already have or pay for the upcoming future tuition? So if we're going to pull out a big lump sum, does it make sense to pay off these loans that we already have, or should we hold on to this moving forward? Again, we'd want to do kind of a cash flow analysis here to look at both, right? What are we paying currently on loans per month? What is the rate that we're paying for those? Does it make sense to throw the money all there? Does it make sense to kind of chop it up and use some of it for the future moving forward? We could make a firm recommendation because, for example, in years past, we might say, we want to use that on just moving forward. But now with the rates being at kind of historic lows, we might say pay off what's going on in the past, and at least this year, we're going to take advantage of these much lower rates for the most part across the board. Okay. So a good question there, but again, not an easy solution. Okay. Okay. So for the federal government program, what they have is either an unsubsidized loan or a subsidized loan. They make it very confusing. So it says right on your financial aid award letters, this dollar amount is subsidized versus this dollar amount that is unsubsidized. The subsidized amount does not accrue interest while the student is in college, and then we have a 6-month grace period after. Okay, so subsidized student loan, subsidized direct loan does not accrue interest while the student's in college. The unsubsidized amount starts accruing interest as soon as that money is dispersed. Okay. So generally speaking, a parent cannot get a federal or state loan if they are not a U.S. citizen. And usually that means they're going to need at least a cosigner, what they call endorser, here in the States that is a U.S. citizen for a federal government loan or a loan within the private sector or the state for that matter. So generally speaking, we're going to need at least a cosigner to qualify for any of these programs that we have in the States. Okay. So it's important to arrange a payment plan with the college before developing other loan strategies. What I would say to that is yes, is because the first thing is you want to figure out, well, what can we do with cash flow right now? Because then that's going to dictate how much we need to borrow after the fact. So that's kind of your first place that you start. What do we have for resources on hand? What can we do for cash flow? And then if there's a difference that we're still going to need to borrow, let's go figure out the best way to do that. So if we have a 529 that's in one student's name, whether it's a twin, whether it's a younger sibling, can we pull from that and use it for a different sibling? The answer is yes. They're very flexible. You got to talk to your financial institution and talk through the logistics of that. But the short answer is, if you have 529, we can rob from the younger one to pay for the older one if that's the deal. But again, you need to talk to your financial institution in terms of the logistics, it's usually just signing a one-pager to say that you're transferring ownership to a certain amount. Okay. So the parent that has the low income, okay, if one parent has very low income, we can put the plus loan in just their name. And then when it gets into repayment phase, we can have the repayment be just based on the income of that student. So, I'm sorry, of that parent with the low income. So it would just mean for the parents that are two household families that just have the one parent with the lower income, we might take out the plus loan in their name. Now there's no income requirements to qualify for it, just credit requirements, and then we can set up a repayment plan that's income based and tied to a very low income, and therefore make, even if we borrow a huge amount, have really manageable monthly payments, and then maybe have a bunch forgiven after 30 years, and we'll take the tax hit in that 30 years. But it's an interesting way to navigate that particular option that makes a lot of sense for some families. So any just one parent needs to be on any of these loans. The only reason two parents would need to be on is if one parent did not qualify from a credit standpoint. Okay, and again, I would recommend applying for the full student loan freshman year, subsidized and unsubsidized. Don't forget, guys, even if it's unsubsidized, we're talking about 2 points and change on a relatively low amount. So the pros and cons of taking the whole 5,500 freshman year outweigh the cons. And again, if you can pay it off the next day before any interest accrues, pay it off the next day. It still establishes all the credit. So it looks like we got to everything, guys. I appreciate the great engagement. Again, we're not going anywhere. We're going to get everybody to the finish line. Thanks for your patience. I know, with all this, from a timeline standpoint, this usually happens earlier in the year, but I hope you learned a lot. And, again, thank you for the engagement and congratulations to everybody. We know kids are going off to college next year. So it's very, very exciting time. We're getting back to some normalcy here, at least in the Northeast. Hope you guys are experiencing the same, and look forward to checking in soon.